Hey guys, welcome to my channel. I hope you guys are doing well. In today's video, we will learn about capital asset pricing model, popularly known as the CAPM model. In this, we are going to learn about the meaning of CAPM along with this assumptions, then formula of computing CAPM, and then the illustration. And then very importantly, the two elements of CAPM, that is capital market line and security market line. And at last, we are going to sum up with implications and limitations of CAPM model. So let's get started. So before we understand the meaning of CAPM model, this model was introduced by William Sharpe in the year 1964, and further John Linter and Jan Mawson have evolved this model. Now, what does this model says? This model provides a determined required rate of return of any security, and it helps to determine the relationship between risk and return of any security. Now, say of any security, say for X security, the risk and return has been determined, right? CAPM model will give you the expected return. Using the CAPM model, expected return can be computed, and once you compute the expected return, you can see whether your security is fairly valued or not. Now, how can you see whether the security is adequately valued or not? You will compare the expected return that was computed through CAPM with that of the actual return. The estimated or the expected return will be compared with actual return, and then you can value your security. You will understand whether your security is undervalued or overvalued with the help of the CAPM model. Okay, this model has certain assumptions that you need to keep into consideration before applying this model. First is the risk averse investors. Now, what does this mean? With lesser or the same level of risk, more and more return is being expected by the investors. Next is the choice on the basis of risk and return. Every investor can make the choices on the basis of risk and return, which security or the portfolio he wants to take. Then similar expectations of risk and return of all the investors. Next assumption is identical time horizon. Now, what does this say? Supposedly, when the prices are going down of any security, say for security A, this is the time when most of the investors are going to enter. The time horizon will be same, identical time horizon. And when will they leave? When the prices of the security will rise. Right? I hope you've understood. If not, then please comment in the comment section. I will definitely reply to you guys. Next important assumption is free access to all information. Now, what does this mean? The information is equally being assessed by all the investors, and no investor has any access to any special information that can influence the securities prices in the market, right? Everybody has the same level of information, and nobody has any special information that can influence the prices of the security. Next important assumption is that there is risk-free assets and there is no restriction on borrowing and lendings at the risk-free rate. Now, what are risk-free assets? These are like treasury bills, right? And government bonds that has minimal risk and your returns are almost assured. This is the meaning of risk-free assets. So, in CAPM, you have risk-free assets, alright? Then there are no taxes and transaction cost. Then total availability of asset is fixed, and assets or securities are marketable in stock exchanges and are easily divisible. Now we have the formula for computing the expected return in CAPM. First of all, we have risk-free returns. right? As we've already discussed, what are the risk-free returns from treasury bills or say government bonds or any other security of the government where the risk is minimum and returns are assured. Now, what is beta? First of all, we know that there are two types of risk. One is systematic and another one is unsystematic. Now, what is systematic risk? This is your beta, right? As you've already studied that unsystematic risk can be eliminated through diversification of your portfolio, whereas systematic risk cannot be eliminated or minimized because it is equally present in all these securities. So this is your systematic risk. And then we have the expected return of the market. RM is your expected rate of return of the market, and this is again your risk-free premium. Now let's understand this formula. Over here, see, this is my systematic risk. If this is my risk, this is my return. Alright. In CAPM, what we are doing? We are taking this risk-free return. Say if I invest in government securities, there will be least risk. At zero level of risk, I am getting this much of return. This is my what? Risk-free return. Right? However, if I want to increase my risk from 0 to here, the market is going to give me benefit for that. So this is my risk premium. Risk premium. What is risk premium now? Your risk premium is anything beyond which this is your risk-free returns, right? Anything beyond your risk-free return is your risk premium. That means for taking this much level of risk, you have increased this much level of your returns. Have you understood? Now going back to the formula. This is your risk-free returns and this is your beta, right? Beta is your systematic risk. For taking the systematic risk, your returns have been increased. This is your risk premium, right? So as you can see, this portion is known as their risk premium. Another thing that you need to note over here is that what does beta tell you? Beta tell you about the market, right? Now let's understand more about this beta. Now if I say beta is 1, what does this mean? If there is 1% increase in the market returns, there will be equally 1% increase in my securities return or they say portfolios return. And if I say beta is more than 1, what does this mean? The return is more than that. The return in portfolio, my portfolio is more than that of the market, right? If I say beta is less than 1, what does this mean? This means the returns is lesser volatile than the market, right? If there is an increase in market by 1%, there will be lesser returns in the portfolio if beta is less than 1. I hope this formula is clear to you guys. So let's move further, and I've taken an example. Over here we can see that risk-free return, that is when you are investing in treasury, is 2.5. Alright. And then you have is your risk premium, where we can see that average excess historical annual returns for US stock is 7.5% and beta is given to you, that is 1.25. So for computing the returns, expected return in CAPM, what is the formula? Risk-free return plus beta into risk-free into the returns from market minus risk-free returns. Putting the values over here, what is my risk-free return? That is 2.5% plus what is my beta? 1.25. Now over here it is given average excess historical returns. So directly the premium is given to me, right? Risk premium. So if we compute this, what is the value? This value comes out to be 11.9%. So this is my expected return from CAPM. Now if I compute this, if I say compare this with my actual returns. Say my actual return was 12%. Was it good or not? Yes, it was good. However, if my actual return was say 10%, then it was not good because I expected more. However, actually I received lesser. So, in this case, what will I do? I will evaluate my security again. Right? Now we are going to discuss about the two elements of CAPM. First is the capital market line and another one is the security market line. Now the difference between the two is that capital market line is a graphical representation of risk and return of the portfolio, right? Whereas the security market line gives you the risk and return of the individual security, right? One difference. Another difference is that when I take into consideration the individual security, I will measure it through the systematic risk, right? Whereas in the capital market line, we are going to take into consideration the total risk. That is systematic and unsystematic risk, and that is being computed through standard deviations, right? Now, once you compare this, once you plot the securities on this graph, what is it going to tell you? It is going to give you undervalued or overvalued securities, right? Now, if I say this is a graph of my say CML or SML, it is saying that all the securities that are plotted on this line are fairly priced, right? Whereas securities above the CML or SML lines are underpriced, right? And securities priced below this is known as overpriced. Now, what does this say? What does this say? Let's go to the graph and understand this. Okay. So, over here it is not, it is overpriced. And here it is underpriced. Right? We have taken two of the graphs. One is of CML and another one is of SML. Right? What is it saying is, the returns over here are more than expected returns, right? When the returns are more, what will happen? More and more people are going to buy these. The prices of the securities will come down. And when the returns are less than the expected, what happens? People start selling it, and ultimately the prices is going to come back to this line, that is the SML, right? Similarly, when we see the graph of CML, over here I have told you that your CML and SML always starts from here, right? That means it does not start from 0. Why? Because this is your risk-free returns, right? Without taking any risk, you are going to get some return. This is your risk-free return. And anything beyond that is your risk premium. The market is going to benefit you for taking the risk. This is your risk premium, right? Okay, now comes the implications. First implication is that the investors can do the, what do? They can compute the value of their assets or the security and then compare it with the market value, right? And investors will be compensated for the risk they are taking. Investors can expect return from their investment according to their risk potential. Now, last is the limitation of this model. First is it is based on unrealistic assumptions, like there are no taxes. You know that there are always taxes on dividend and capital gains, right? Besides this, it does not take into consideration the inflation and liquidity. You know the securities that are more liquid have less returns than the securities that are non-liquidable or are less liquidable, right? Then it is difficult to test the validity of CAPM. Then beta does not remain stable over the time. How do we compute the CAPM? We take into consideration the previous record, okay, the previous information from the market. However, the beta is constantly changing and it is highly volatile. So it is very difficult to compute the expected returns. So that is it for today, guys. I hope you've enjoyed and learned something. If yes, then please subscribe to my channel. Thank you and have a nice day.